Hello students, today we are going to start unit number 2 and the topic which we are discussing today is cost of capital. Learning outcomes. After watching this video, you will be able to define cost of capital, understand the significance and importance of cost of capital. You can list out the basic aspect of the cost of capital. You can classify the cost, list out the different steps which are required to compute the cost of capital. You can understand the concept of WACC. You can calculate cost of different sources like debenture, debt, preference share, equity shares, and all. First thing is you must know that what is cost of capital. Cost of capital means when you invest anywhere, you are expecting return as an investor. You are expecting some return. And the company or the business which are using the capital, they're also expecting returns from the project or from the investment. So cost of capital is the minimum required rate of return on the funds committed to the project, which depends upon riskiness of the cash flows. In the earlier video lecture, I told you about risk-free investment, risk-free returns. So when your returns are fixed, it is not changing, it is known as risk-free return. Normally the return given by, you can say, on the government security or given by the banks are treated as risk-free return because they are giving the same return what they promise. Okay, but if you invest on some risky project, your expectation will be high, obviously. You will think about more return than risk free. Otherwise, there is no use of investing in some project. You can deposit the amount in the bank and you will get your risk free return. That's it. But if there is any risk, if you are investing somewhere else, your expectation will be high. The firm's cost of capital will be overall or average required of return on aggregate of investment project. So basically, the cost of capital which a company is using for their decision making will be average or aggregate of all the investments, right? All the sources which the company is using for investment. Now, what are the importance? What are the significance of cost of capital? The concept of cost of capital is very important, is very significant when you are structuring your capital structure, when you are structuring your total capital. If you want to use debt in your capital structure or you want to use own fund, equity share, preference share, then what is the optimal structure? Optimal structure means the structure which is giving least cost of capital to the company. Because if the cost of capital is high, then the savings, the returns, obviously the surplus return will be low. Okay. Suppose you can understand this concept with the help of example. Suppose you are a businessman and you are using borrowed fund. You have taken loan from a bank and you used that amount, that fund in a project. So what will be your expectation as a return from the project? Obviously, you will be thinking that your return must be higher than the rate of interest which you are paying to the bank. If it is not so, your returns are equal to or less than the cost of capital. That means interest here. Because you are using debt fund, so the interest will be cost of capital. If it is less than or equal to cost of capital, the surplus, the profit for you will be nil or very minimum, or it can be negative. If the returns are less than cost of capital, that means the interest which you are paying to a bank, then your surplus will be negative. So the cost of capital concept is very important. You have to decide an optimum capital structure for better earning. Okay. Investment evaluation and capital vesting, the same concept. In case of decisions related to capital vesting, related to acquisition of fixed asset, expansion plan, diversification, you have to check the cost of capital. What type of capital you are going to invest and what are the least expectations. Then only you will be able to decide the expansion plan or investment plan. Financial performance appraisal. If you have different proposal and you want to analyze, you want to select the best one, then cost of capital will be important. Without that, you cannot decide, you cannot rank, you cannot take decision of accept or reject. For financial performance, it is basic requirement. Now, what is different components of cost of capital? Because the company is using different sources in their business. Sources means sources of finance, sources of fund. So different capital, different sources of funds are used by the company in the business. So there are different cost of capital too. If the company is using equity share, the cost of equity share capital will be there. If the company is using preference share capital, cost of preference share capital is there. Then cost of debt, cost of retained earning, and combination of all these will be known as weighted average cost of capital or WACC. So these are different components. So in nutshell, we can see that the component will be the different capital which you are using in the business. If you are using only share capital, then obviously your weighted average cost of capital is equal to the cost of equity share capital. Now, what are the basic concept? Basic concept is rate of return. These are these few concepts which are applicable for the calculation of cost of capital, whatever it is. The above definition indicate that the following three basic concept, basic aspect of the concept of cost of capital, they are rate of return. Cost of capital, as I have already discussed, the cost of capital is basically it is expected return, right? So rate of returns is the cost of capital is not the cost as such, but it is a combination of risk-free return as well as the risk premium. Okay, so it is the rate of return that firm required to earn from its investment. Again, it is same that if the projects, investment projects are risky, the expectation will be high. Minimum rate of return, what is that? It is risk-free return. Cost of capital of any firm is the minimum rate of return that will at least maintain the market value of the shares. The minimum required amount which can be generated if you are investing in the bank or in the government security. So cost of capital comprises three components. First is risk-free return, that is RF, risk premium, that is B, and financial business risk premium, that is B, and financial risk premium, that is F. So simple, that is, if we want to make it all these factors, we want to relate it, we have an equation that is K naught is equal to RF plus B plus F. That means the cost of capital, overall cost of capital for a business is equal to RF, risk-free return, plus business premium. That means the compensation of the risk within the business and compensation of the risk for the financial risk which is due to use of different sources, right? So B plus F, it will give you the overall cost of capital. This is the general equation which will be used. So here you can see very easily that when it is, you can see that when the risk of the investment is increasing, the premium or overall cost of capital will be increasing. Okay. Here you can see that risk-free securities are there. Government bond are risk-free return, giving risk-free return. Government bonds are very secure. Then corporate bonds are little bit risky. Okay, because these bonds are issued by private companies and default risk is always there. Okay, after this, preference shares are more risky than bonds. Preference shares are related to market fluctuations. Okay, equity shares are carrying highest rate of risk. So this picture, this graph will show you that how risk is increasing, and with increase of every, you can say, every point of the risk, your OCC means opportunity of comparable, it is overall cost of capital, not opportunity. Overall cost of capital will be increasing. Now, we know that there are four components normally the companies are using. There are four popular sources, so four component of cost of capital is there. So one by one we will be calculating. We'll learn that how to calculate different component of cost of capital. So first component I have taken is cost of debt, KD. So cost of debt, debt means here means the loan, the borrowing that can be taken from the financial institution, from the bank, or it can be debenture, or it can be bond, right? All these are different formats of debt. So cost of debt is calculated on debt, bond, loan, or debenture by multiplying interest rate with given amount of debt. That is known as KD. KD is notation which is used for cost of debt. So if debt is redeemable, suppose it is a debenture and debenture is irredeemable. Irredeemable means it will not be redeemed, right? It is the, you can say that maturity value is infinite, right? Irredeemable debenture. So in that case, cost of debt KD is equal to I upon B naught into 100. 100 multiplied by 100 to make it percentage. So what are the notation? KD is cost of debt, I is rate of interest, B naught is the net sale proceed from the issue of debt. If there is income tax, rate of income tax is given in the question, then what happened? I 1 minus T divided by B naught multiplied by 100. This will change, right? So 1 minus T, that is what T is equal to tax rate. So tax rate is suppose 30%, the 1 minus T means 0.7. 30% means 0.3, 1 minus T means 0.7. So I, interest, will be multiplied by 0.7 and then we use the formula. So one thing here you have to remember that I, rate of interest, will always be applicable on the face value of bond, face value of debenture. So it will be calculated always on the face value. B naught is net sale proceed from the issue of debt, and B naught, there we have a formula to calculate B naught. B naught is equal to FV. FV means face value plus premium on issue minus discount on issue minus flotation cost. Do remember that bonds or debenture are issued either on premium or discount. Both of premium and discount parallel will not there. Either it will be issued on premium or it will be issued on discount, right? Now we have to deduct flotation cost. What do you mean by flotation cost? Flotation cost means the cost which is related to the issue of the debenture. That means underwriting commission, the printing cost, the legal cost which is related to issue of debenture or bond. Okay. Now, second is cost of retained earning. Cost of retained earning means when company is earning profit, company has option to give dividend to the shareholders or retain it within the business for reinvestment, right? For circulation of the money. Retained earning is one of the internal source to raise equity finance. Retained earning are those are part of the earning which are retained by the company, by the firm, right? And it will be reinvested in the business itself. So retained earning basically is the component of the profit which belongs to the equity shareholder. Retained earning, if it is not retained, it should be given to the equity shareholder. So the cost of retained earning will be similar, will be equal to the cost of equity share capital, because this is the fund which is related to, which belongs to equity shareholder. So the cost of retained earning will be equal to cost of retained earning. The opportunity cost of the retained earning is the rate of return the shareholder forego by not paying, putting his or her fund elsewhere, because the management has retained the funds. So what it means, that means if the management or board of the director has not retained the fund, has not retained the profit and not reinvested in the business, then this amount will be with the shareholder and they have an option to invest that amount anywhere of their own choice. Any investment option they can choose. So in nutshell, it is like opportunity cost. Okay. For your calculation purpose, you always remember that KR is equal to K. Okay. Again, we have a slide. It is related to calculation of KD. KD, if it is redeemable. Redeemable means if it has maturity value. In the previous slide, here we can see that calculation of KD if it is irredeemable, and here we can see if that is redeemable. Redeemable means the fixed maturity time is given in the question. Then how it will be calculated? It can be calculated by using this formula I1 minus T plus RV minus B naught RV minus B naught divided by N total divided by RV plus B naught divided by 2. You can use this formula. Otherwise, calculation of KD is based on hit and trial method. Hit and trial method can be done as we can calculate IRR, hit and trial, no? Calculating KD or at hurdle rate 10%, 12% like that. But you can, by using this formula, you can easily calculate. So notations are I is interest on the debenture or bond or debt. T is tax rate. RV is redemption value or maturity value of the debt. B naught is the net sales proceed. N is time value, maturity time of the debt or debenture. So debt or debenture here you can easily relate it that if there is a debenture, it must have a face value, right? Face value is there and interest is calculated on the face value. After maturity time, the company have to return the principal amount, that is the face value, and redemption can be at par or premium. At par means similar to face value, equal to face value, and at premium means that some amount will be added on the face value. So suppose the face value is 100 and it is redeemed at par, it means at the time of redemption, debenture holder will get rupees 100 only. But if it is redeemed at 10% premium, then debenture holder will receive 110 rupee. 100 as face value and 10 rupee as premium. If nothing is given in the question about redemption condition, you have to always take it as par. At par means at face value. Flotation costs are incurred by a publicly traded company when it issues new security, or it can be debenture, shares and all, and includes expenses such as underwriting fee, legal fees, registration fee, printing of memorandum, printing of applications, right? Merchant bankers commission, etc. Now, how to calculate cost of preference share, KP? So, preference shares are very similar to debenture, but there are certain differences too. Preference shares can be redeemable or can be irredeemable. Okay. So, if preference share is irredeemable means again the same concept that the no maturity value will be there. Then the maturity time will be infinite. It will never be redeemed. So cost of preference share capital notation is KP is equal to amount of preference dividend divided by preference share capital P naught. Right? P naught is basically net proceed. Net proceed on the issue of preference share capital. So KP is equal to PD upon P naught. P naught is annual preference dividend. P naught is net proceed. Net proceed is equal to par value of preference share, or if it is issued on premium, then premium will be added. If it is issued on discount, discount will be deducted, and cost of flotation. The concept of flotation cost, discount on issue share premium, that is very much similar to the concept which I have already told you in case of debenture. There will be no adjustment of tax. Like in case of debenture, we have to adjust T, 1 minus T. We have done I into 1 minus T. But in case of preference share, tax shield will not be available. So tax adjustment will not be there. Dividend will be given to the shareholders which are out of after tax profit. Okay. So this is the reason why tax adjustment is not required. So dividend of preference share capital is payable on the net profit after tax adjustment. So no need for the adjustment, right? Cost of debt, in case of cost of debt, the interest will be deductible expense for the calculation of tax. That's why tax adjustments will be there in case of debt. But cost of equity share capital or cost of preference share capital, no tax deduction will be made by the company. Okay. The concept of flotation cost will be similar to in the same way as I have already told in the previous slide. Now, if preference share is redeemable means having maturity time in the question. That means the preference shares are given back to the preference shareholders after some time. So that time will be known as maturity time. After 10 year, after 20 year, the shares, the principal amount of the shares will be given to the shareholders, and this process is known as redemption. Okay. So if maturity time is there, then the shares are known as redeemable. How to calculate the cost of preference share capital in case of redeemable preference shares? It will by using this formula only: PD plus RV minus P naught upon N, RV plus P naught divided by 2, averaging of RV plus P naught. Notations are: N is maturity time of the equity preference shares, RV is the redemption value or maturity value of the preference shares, PD is annual preference dividend which is paid to the preference shareholders. P naught is net proceed. Net proceed can be same thing. It can be at par, at discount, at premium. So if it is at par, then face value plus share premium. If it is at par, that means in that situation, the net proceed will be par value minus flotation cost only. If it is issued on the premium, then par value plus premium minus flotation cost. If it is issued on discount, then how to calculate P naught? Par value, that means face value of the share capital, minus discount minus flotation cost. Okay. Preference dividend, PD, will be calculated on the face value only. Okay. So if nothing is given in that situation, how to calculate redemption value? If nothing is given, then par value, face value will be taken as redemption value. Or if it is given in the question that redemption is done by the company on premium, then premium amount will be added on the face value. There is no case of redemption on discount, right? Redemption on discount is never, it will not be there. Okay. Now, the last source of capital, that is cost of equity share capital. How to calculate K? So there are two cases, right? For calculation of cost of equity share capital, there are two cases. First one, when dividend is constant. If a company is paying dividend and the rate of dividend is constant, it is not growing, it is not increasing or decreasing. Okay. In that situation, the cost of equity capital can be measured with the following formula. K is equal to D1 upon P naught. K is equal to D1 upon P naught. Notations are: K is cost of equity share capital. D1 is expected dividend per share at the end of year 1. After year 1, what is the expected dividend which the company is going to pay to its equity shareholder? And P naught is current market price per share. Or if it is a new share, new company, first time the company is issuing shares and it is not listed, so market price of the share will not be available. In that situation, net proceed per share will be taken. This method assumes that investors give prime importance to dividend and risk in the firm remain unchanged. These are the assumptions, and does not consider growth in the dividend. Then only this formula will be applicable. Now, what happened if the dividend is growing at the rate G, right? It is increasing or decreasing. Normally it is increasing. Under this approach, cost of equity capital is determined on the basis of expected dividend rate plus rate of growth in dividend. Here, the notation for rate of growth is G, small g. Small g is growth rate in dividend. So this method substitute earning per share by dividend and recognize the growth in it. Okay. So the formula is K is equal to D1 upon P naught plus C. Notations are: K is cost of equity share capital, D1 is expected dividend at the end of year 1, P naught is market value or net proceed, plus G is the growth rate. Okay. How to calculate D1? D1 can be calculated by using these two equations. D1 is equal to D naught plus 1 plus G. So if you want to calculate dividend after 2 years, then what happened? D2 is equal to D naught 1 plus G to the power n. So to generalize this formula, we have a general equation, that is Dn is equal to D naught 1 plus G to the power n. Okay. We have one more formula, one more approach you can say to calculate K. If EPS is given and market price is known, it is known as earning yield method. So EPS is known, or market price of the share is known. Then KE can be calculated by dividing EPS by market price. EPS upon MP or EPS upon P naught. By using this formula, you can also calculate earning. You can also calculate cost of equity share capital, and this formula is known as earning yield method. Okay. By using the equation, which is the previous one, growth rate model, growth rate approach, you can also calculate P naught. P naught, that is market price. How? We know that the cost of capital equation is K is equal to D1 upon P naught plus G. So by transferring the variables here, right, you can calculate P naught. P naught, put this P naught here and transfer all the variables there on the other side of the equal sign, D1 upon K minus G. This formula can be used for calculation of your market price. Okay. So you can also see that in this equation there are 4 variables. So if 3 variable is known, then by using this relationship, this equation, you can calculate 4th variable. You can also calculate cost of equity share capital by using CAPM model. CAPM model means capital asset pricing model. Okay, this model is very popular, right? And it has given simple formula. Okay, you can use, but there's one condition that this formula can be used only in case of listed shares. If shares are not listed, right, in that situation you cannot use this formula. Cost of equity is calculated by using CAPM, which equates rate of return to volatility, that means fluctuation, risk versus reward method. Below is the formula for cost of equity. K is equal to RF plus beta into RM minus RF. Now notations are, RF is risk-free rate of return. I have already told you, we discuss a lot. Now, for example, you can take back interest or GSEC interest, government security interest. B is beta, equity beta. Beta is given in case your shares are listed. If shares are not listed, then beta will not be there. RM is return, annual return of the overall market. Market means stock market. So cost of equity is an implied cost or an opportunity cost of capital. It is the rate of return shareholder require in order to compensate them for risk, volatility. That means what are the changes, the fluctuation in the returns, right? That is known as risk. Then beta is measured of the stock's volatility of the returns relative to the whole market. That means if beta is 1, that means the risk is very much similar to the market. If beta is greater than 1, that means the risk of individual share is greater than market. If it is equal to 1, then risk is equal to share market. Okay. Now, next concept is weighted average cost of capital, also known as WACC or K naught. After the cost of each component, we have already covered the cost of each component. It is debt, then retained earning, then preference share, then equity share, right? And normally the companies are using all the 4 components, all the 4 sources of finance, source of capital in their capital structure. So in that situation, if company is using all 4 sources, a blended or average cost of capital is required for the decision making. The result of this calculation is company's WACC or average cost of capital, a piece of information that is very important for, to the management of the firm's asset. For the decision making, capital vesting decision or evaluation decision, you need WACC, not individual cost of capital. WACC used to make investment and business decisions and is often used as a benchmark in determining the business unit's performance. Now, how to calculate? To compute WACC, multiply specific cost of capital. Specific cost of capital means cost of capital of individual component of the capital structure of each. Again, multiply the specific cost of each form of financing by its proportion. Proportion means total ratio of the individual source in the total capital. Okay, proportion of the firm's capital structure, then sum the weighted values. If you want to make it in as equation, then equation will be K naught is equal to WACC is equal to WEKE. WE means weight of equity share capital. Weight of equity share capital means proportion of equity share capital in total capital of the company. Okay. Suppose the total capital of the company is suppose 10 lakhs and equity share is 5 lakh. So weight will be 50%. 50% of the total capital is equity share capital. This is the weight. Okay. Now multiply by KE plus WPKP, WDKD and WRKR. WP means the weight proportion of the preference share capital in total capital. Similarly, WD is proportion of debt in total capital and WR is proportion of retained earning in total capital structure of the company. KE, KP, KD, KR is cost of equity, preference, debt and retained earning. Okay. Now, you can see for example of WCC how it is calculated. Okay. Now see if in the capital structure of the company, there is only two type of capital which is used by the company. For example, it is debt and equity. Okay. Cost of debt is 60%, tax rate is 30%. Cost of equity is 15%. That is already given. This is specific C by C. Specific C by C means specific cost of capital. Then how to calculate weighted average? Okay. Now see here, and the weight is given 25. The company is using 25% of debt and rest is equity. Rest means 75%, right? Total is 100% and there is only two sources. One is debt and another is equity. And proportion is 25% debt, 75% equity. Okay. So it means the proportion means WD. WD is 0.25 and WE is 0.75. WD and WE, right? This is the weight, the proportion, and then cost of capital. How to calculate KD? KD, if the interest rate is 6% and tax rate is 30%, then how to calculate KD? For KD, we have to adjust tax. That means 1 minus T. Okay. So cost of debt after tax is 4.2. How it comes? 6% multiplied by 1 minus T. 1 minus T means 70%. So 6% into 0.7, that means 4.2% is the net effective cost of debt after tax, right? In case of cost of equity, there is no adjustment for the tax rate in case of equity share capital. Okay. So weighted cost of the debt is equal to 1.04. How it come? It is KD into WD. KD into WD. KD is 4.2% and WD is 25%. Multiply these two, you will get weighted cost of debt is 1.05. Similarly, in case of equity, K is equal to 15%. 15% means 0.15 and WE is equal to 0.75. WE, proportion of equity in total share capital. It is 75%. 75% means 0.75. Okay. By multiplying these two, 0.15 and 0.75, that means KE into WE, you will get your weighted cost of capital is cost of equity capital 11.25. And for calculation of WCC, we will add these two. These two means weighted cost of debt and weighted cost of equity. And overall cost of capital, average cost of capital for the company will be 12.3%. Okay. So this is example how we calculate. If preference share is there, then obviously for the component of the preference share KP and WP, we will take that one for calculation of WACC. In this example, we will assume that there is only two sources. First is debt and second is equity. And the proportion is 25% of debt and 75% of equity. With the help of this, you can calculate WACC. So thank you. That's all for this unit.